the amazing short-term rental loophole. Cost segregation. If you're in real estate, you have heard this term so many times. Everyone's talking about it, bloggers, everyone's flexing on IG. I've made reels about it, but it really has come to my understanding that a lot of people still have a lot of questions on it. And I do think it's a very complicated Internal Revenue Code loophole, but I wanted to make a detailed video to explain to you what it means, but also I really do think an example is going to help you guys understand it in more depth. So I'm gonna make a video, and at the end, stick to the end because you will see a real life example of what the short-term rental loophole can do for you. My name is Anna, and I help real estate investors all over the country play the IRS game by using the tax laws that are currently in place to just play like the wealthy do. They don't want to pay taxes, so that's what I was born to do. If you guys like this video, make sure that you subscribe to my channel, share it with everybody, and if there's anything you want me to talk about, tax related, personal, it doesn't have to be specifically about real estate, leave it in the comments below and I'm happy to do so. So let's get straight into the video. Let's start from the beginning. When people think about getting a rental property, they do it because they think, or because they've heard they're going to get this huge write-off that they're going to be able to use against their W-2 income. And if you see my videos, it depends. So if you are working a W-2 job and you decide that you want to invest your money into real estate, you go and you buy a duplex. So now you have this duplex and that's generating income, but you know that you've heard that you can create losses at the end of the year through depreciation. So you go to your tax preparer and you're like, hey, this is so cool. I make money at Chase and I bought this rental property. And it's gonna give me a loss and it's going to net each other, and boom, my taxes are gonna be lowered. And it depends. This is why I tell people, do not just go give your money out to syndications or just go do things because you don't know everything about it. Now I say it depends because if your adjusted gross income is at $150,000 or more, you are not allowed to take any of those losses against your W-2. So let's say, for example, you work at Chase, you're single, and you make $200,000, and you go and buy a triplex. And that triplex, with the depreciation that you don't need to know how to calculate, your CPA should do it, generated a $10,000 loss. You think, cool, I made 200 over here, it's going to net, and it's gonna bring down my taxable income. It's not. Unfortunately, as soon as you make over $150,000, those losses are considered passive and you will not be able to write them off against your W-2 unless you qualify for real estate professional status. Now, we'll get into detail of what that is. Let's say you make $95,000 at Chase and you go buy a duplex. And this new duplex is actually giving you a $25,000 loss. Since your adjusted gross income is less than $150,000, you will be able to use that $25,000 against your W-2 income at Chase. Essentially, the IRS gives anyone who makes less than $150,000 in their adjusted gross income $25,000 loss from their rentals. In other words, if you make $95,000 and you have multiple rental properties and they generate a loss of $50,000 altogether, you will only be allowed to take $25,000 each year. And it won't you don't lose that loss, it just gets stored away and then you get to use it every year or when you sell the properties. Now, what happens if you make between 100 and 150? Well, that's the threshold. You will still get $25K, but it starts going down as soon as your adjusted gross income continues to go up. So as soon as it gets to 150, it's phased out. So in between 100 and 150, that $25,000 allowed loss will start reducing. Hopefully that makes sense on how you are allowed a $25,000 loss for your rentals if you have long-term rentals. So now let's talk about how do people get to write off those losses, those big real estate losses against some of their W-2 income or their business income. And here it is. The only way you can do this is if you qualify for real estate professional status. And the reason why this was created, I'll give you a little bit of background, is back in the day before I was born, I don't even know the year to be honest. But what's happening is high net income earners who made like $500,000 were like, okay, let me go get these rental properties, depreciate them, and then use them against my high W-2 income and then pay zero taxes. And when I tell you guys, the IRS is always a step ahead of us. They were like, no, that's not gonna happen because we need money, we're in debt, so we need to generate revenue through taxes. That's not gonna happen. So the only way that you can take larger than $25,000 loss is by qualifying as real estate professional status. When I tell you, you wanna flex on anything, if I qualified for real estate professional status, you guys, I would have a sign on my forehead being like, reps. Because that's a true flex, because it's so amazing. And here's why. If you qualify for reps, also, side note, qualifying for real estate professional status does not mean that you just have to go get your real estate license. You don't have to. So wherever you see that or wherever you hear that, you don't even need your real estate license to qualify for reps. I'm gonna show you how you can qualify for real estate professional status. Qualifying, I'm gonna stop saying that, I'm just gonna say reps. Qualifying for reps is actually very hard. Keep in mind, this is for long-term rentals only, okay? 2 tests. Test number 1 is you have to prove that you work more than 1/2 of your time in a real estate trade or business. What that means is that if you work 2,000 hours at Chase, you need to prove that you work 2,001 hours in real estate. Not gonna happen, not going to happen. It's just you'll never sleep, right? But let's say you have a part-time job. You might qualify. You may work 500 hours at Home Depot and work 600 hours in your rentals. Then you might be able to qualify for step 1. Step 2 is materially participating in your rentals. Now, what does that mean? That means that you have to be actively materially participating in your rentals. There's 7 tests. I'm not gonna go into it. It's too much. I will make another video. But essentially, you have to really be the landlord of your rentals. Now, if you have a W-2, you're working full-time, and you have a couple of rentals over here, I'm gonna be the bearer of bad news and tell you that you're most likely not going to qualify. Okay, it's just not gonna happen. There's no way that you're working a full-time job over here and managing your rentals 1 times more than at your real job. Not gonna happen. However, now let's talk about what we really came to this video to talk about, which is the short-term rental loophole. The short-term rental loophole allows you to bypass test number 1, which is a hard test to get to. You only have to prove material participation. So what does that mean? That means that I could work at Chase, a full-time job at Chase, a 9 to 5, 2,001 hours, or however many hours 9 to 5 people work, and have a short-term rental and actually take the losses from the short-term rental against my W-2. How do people do that? Here's how they do it, at least in the first year. They do it by doing what's called a cost segregation. And a cost segregation essentially is you have a firm that comes out to your property and takes every asset class and depreciates it in different life. If you didn't do a cost segregation, you would essentially, I'm giving you guys the easy form of doing depreciation, you would essentially take the purchase price and divide it by 39 years. 39 years is a long time, so it's giving you no depreciation. By doing the cost segregation, you're breaking up those asset lives. So what's happening is the furniture, the cabinets, other things can be depreciated right away. Last year was the last year for 100% bonus, but you still get 80%. So let's say, for example, on a $250,000 property, you get a cost segregation, and the cost segregation comes back and you get, let's say, $80,000 loss. So now you can use that loss against your W-2 income from Chase. And I'm gonna show you an example how that works. But essentially, the short-term rental loophole, as long as you materially participate and you have a time log, because the time log is really important. And you might be asking yourself, do I really need to keep track of the time, Anna? Like, what is a time log? Yes, 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 yes. This is very highly litigated in the IRS. And the reason why you need to keep a time log is because the IRS is going to ask specifically for that time log. So just get a timesheet or get an Excel spreadsheet, document every time you are talking to your guests, talking to the contractors, talking to the cleaning, all that stuff needs to be documented. That is how people are utilizing the short-term rental loophole. I do want to give caution though. I don't have short-term rentals, so I can't really speak on it, but I have a lot of clients that do. And you have seen a lot on TikTok, on social media about this downfall. I don't know, I'm not a magician, I don't know. However, please, please, please do your due diligence when it comes to short-term rentals. It is a lot of work. You can ask anyone who has a short-term rental and they can tell you that it is a full-time job. Once you get processes and all that stuff, it will work, but it's not as passive as a long-term rental. The benefits are huge, as you will see in the example. However, this is why tax planning comes into play, because you use the cost segregation 1 year, but next year you don't have that big write-off. So what are we gonna do? Tax planning is very important. So hopefully that made sense, but really what's going to click, you guys, is the example, which we will get right into it now. Okay, so I'm giving you a freebie lesson on a lot of things here. So we're gonna take a look at what are the actual data. You see here, Bob, he's a W-2 earner, works at Chase, $250,000. He is single, and he decided to buy a short-term rental in California for $500,000. Now, these are all for numbers. Don't come for me if you're like, that's not exact. Okay, this is just for you guys to understand how it works. He gets a cost segregation done and they tell him he's going to have, after all expenses, he has a really nice profit and loss statement of $116,000. So let's take a look at how his taxes would go if he didn't have this. No short-term rental on this side, W-2 of $250,000, a standard deduction of $12,950. That's all the deductions he really gets. As a W-2 earner, you guys, if you go watch my videos about LLCs, you will know that they have very little deductions. So his taxable income is $237,050. So here's a really brief overview of how it's gonna look like, how taxes are actually calculated. It's a freebie. So essentially, we're going to take a look at the tax brackets. I will put them here. The tax brackets is what's going to tell you how you're going to be taxed. So on 237, you're going to look at the tax bracket for single, and we are going to look at the number that says between 170 and 215. So your first bracket is you're going to be taxed $34,648. Anything above 170, $050. So 237 minus 170, $050, which is $67K, will be taxed at 32%. So times 32%, that's $21,000. Your total tax is going to be $56,000 if he makes $250, has no deductions, no cost segregation. That's what his taxes are going to be. Now, whether he withheld them or not, that's a different story. We are talking about how much he actually will owe at the end of the year. Of course, if he will withheld enough, well, that's going to make a difference. So now let's go to what happens if he gets a short-term rental and he uses the short-term rental loophole. So with the short-term rental loophole, it's kind of the same thing. We have the W-2 at $250, but we have a loss of $116,000. The standard deduction of $12,950. So we are looking at his taxable income of $121,050. We look at the tax bracket that I told you, we are looking now at the 25%. So his tax is $15,213, and anything above $89,075 minus $89,075, that's $31,975 times 24%. That's $76,74 plus $15,213, so $23K minus $55,000. There is a difference of $32,000 just by doing the cost segregation. So that's the example. Hopefully this helped. Make sure you subscribe to my channel. Bye. Play the game, people.